First learning objective, describe characteristics and risks of covered bonds and how they differ from other asset-backed securities. Okay, covered bonds. This diagram at the top of the screen explains it quite well. Here is the bank's balance sheet. Notice that we have loans sitting under the asset side. The loans remain on the issuer's balance sheet for covered bonds. They do not leave like they would if they were securitized. They are segregated, which means the bank ring fences certain eligible loans to create the cover pool. So let's just imagine this is your cover pool over here. These, again, they stay on the balance sheet. And bonds are sold against this collateral. And this collateral provides the interest and principal repayments. To make sure that the bank is being honest about the covered pool and the fact that they are segregated and that those assets do meet the specifications required, there is an asset monitor that reviews the covered pool. And the bond investors get dual recourse. They have a claim on the covered pool, which means they have a claim on all the assets in the covered pool, and they have a recourse to the unencumbered assets of the issuer. The covered pool, when we put loans or when the bank puts loans in the covered pools, they're typically, not always, but typically commercial or residential mortgages. Typically one bond class per pool is issued. The issuer must replace any prepaid or non-performing assets. So if one of the commercial mortgages or residential mortgages prepays, well then it disappears from the covered pool. The bank must replace it with something else. The covered pool dollar value is typically greater than the dollar value of the issued bonds. So you have a form of credit enhancement here on top of the fact that they are segregated assets, also on top of the fact that the bond investors have recourse to the bank itself. The pool has an over-collateralization credit enhancement. And of the loans that are in the covered pool, they must meet certain standards, such as a specific loan-to-value ratio. Let's look at the different types of covered bonds: hard bullet, soft bullet, and conditional pass-through. So hard bullet covered bonds, payments are accelerated with default. An issuer sells loans to meet full redemption. So you have, let's say, 5 years. And at the end of 5 years, there is a bullet payment on those bonds that are due. But these are mortgages, right? Well, interest rates might have changed in such a way that at this point in time, the cash isn't there to meet the bullet payment. Under such a condition, that would be tantamount to a default. The underlying mortgages are sold to pay the bullet payment. So payments are accelerated with default. The issuer sells loans to meet full redemption. Soft bullet covered bonds, payments are delayed with default. So if conditions work out such that these mortgages are still outstanding and the cash flows haven't arrived to pay this amount, it is just extended possibly for another year. Extend the final redemption date up to 1 year. So, for example, lack of prepayments, you don't have enough to meet the bullet payment, it can be extended out to 1 year. That's why it's called a soft bullet covered bond. The hard bullet, you got to pay me here. Soft bullet is, well, you don't have it? Well, I'll tell you what, why don't we just extend? And then you have the conditional pass-through covered bonds, that if on the redemption date, you don't have the funds to meet the redemption, they simply convert to pass-through securities. They convert to a pass-through after original maturity date. So it's not as if you're extending it for 1 year. They just convert to a pass-through, which might last another 2 or 3 years. Covered bonds usually carry lower credit risk. We saw on the first screen all of the credit enhancements that were there. You have over-collateralization. You have recourse to the loan pool itself. And if that's still not enough, you have recourse to the issuing bank itself. So they usually carry lower credit risk and as such offer lower yields. Soft bullet covered bonds have lower credit risk than hard bullet covered bonds. That may not seem obvious at first, but remember, under the hard bullet, you owe all that money at this point in time. Well, if you have the flexibility of saying, well, can I have a little bit longer because the loans are taking a little bit longer, there's less credit risk involved. Next 2 learning objectives in this module, they are quick. Describe typical credit enhancement structures used in securitizations and describe types and characteristics of non-mortgage asset-backed securities, including the cash flows and risks of each type. Okay, let's discuss some credit enhancements. 3 internal types of credit enhancement. First one is called over-collateralization. So a originator will sell $100 million of mortgages to an SPE, but receive or agree to receive $95 million in return. So there's $95 million in bonds outstanding against a pool of mortgages of $100 million, and the bank or the originator would retain a 5% equity position in the SPE. Another one is excess spread. The average coupon on the underlying collateral less the average coupon on the bonds. Another way of saying that is the aggregate interest collected less the aggregate interest paid. So for example, the underlying pool of loans or bonds or mortgages could have a 6% weighted average interest rate associated with them. The bonds issued could be issued with a 4.5% coupon bond. So you can see there's 150 basis points of excess spread to absorb losses or build up reserves. Any excess cash after all the bonds would be paid, any excess cash accrues to the equity slice. And finally, subordination, or what is referred to as tranching. Different classes of bonds with different yields and different degrees of risk, referred to as a senior subordinate structure. And distributions are by the waterfall approach. We'll see an example of that on the next screen. Basically, it works like this. Interest every month go to all classes of bonds. Any principal flows to the senior tranche first until they're paid off. Then any interest, any extra principal will flow to the next level of seniority, etc. So once the first tranche or the senior tranche is paid, then it flows to the more junior tranches. Okay, here's a nice structure at the top of the screen. You have 4 tranches, A, B, C, D, and let's assume that there is 100 million of bonds that are issued. And for now, we'll just assume that 97 million of the principal is recovered. There were some defaults, some foreclosures, and some principal was lost. So every month, every single tranche or every single class of bond gets their interest. The lower the tranche, the more credit risk there's involved, the higher the interest or the higher the coupon on those particular bonds. All principal that's received goes to tranche A first. In other words, as long as tranche A has principal outstanding, B, C, and D get no principal payments per month. They get interest only. Once tranche A is being paid off, they're done, they're retired. The money then flows to tranche B. So you can see as the principal rolls in, it fills up tranche A, then it fills up tranche B, then it fills up tranche C, then it fills up tranche E, which is why it's called a waterfall approach. Under this scenario, tranche D would lose $3 million. But A, B, and C would be made whole. If tranche D, let's say, were $5 million in bonds, they would lose $3 million. If tranche D were only $1 million in bonds, they would be wiped out, and tranche C would lose $2 million because $3 million is lost over here. So we see that for tranche C, principal is received only when tranches A, B, and C are fully repaid. This means that lower tranches are offering credit protection to more senior bond classes. External credit enhancements, and this can be done by originators. Guarantees by banks or insurance companies, basically the use of cash collateral accounts as well, or restricted cash on balance sheets. So an insurance company can offer a guarantee, a bank can offer a guarantee. Typically what they can do is, let's say they sell $100 million of mortgages. This is the bank, for example, and they agree to guarantee 25%. They get paid that $100 million when they sell the mortgages to the SPE. Of that $100 million, $25 million would go on their balance sheet as restricted cash, and $75 million would then be free to invest. Non-mortgage ABS. Can be amortizing or non-amortizing. Amortizing, we know the payments are principal and interest. Non-amortizing, there is a lockout or revolving period where prepayments are reinvested. You'll receive interest only during that period, then principal plus interest once the lockout period ends. This is typical with ABS backed by credit card debt. Okay, let's look at the diagram here to look at the structure of an ABS with a revolving period, and credit card loans are a great example to use here. There may be some period of time when principal repayments are simply, this arrow is a round circle, they're just simply reinvested to keep the principal pool constant. And all the finance charges and fees for credit cards, you have late fees and membership fees. All the finance charges and fees are passed through to the bondholders. Then at some point in time, principal begins. This is the amount of time down here. So we can see tranche A ends about here. They're getting principal plus interest while the other tranches are getting interest only. Then tranche B gets their principal plus interest while the other two get interest only. Then you have tranche C getting principal plus interest while tranche D gets interest only. And then you have principal plus interest. If the defaults are held down to what was estimated, there will be a payoff here. If defaults are higher than what was estimated, then tranche D does run significant credit risk at that point. The revolving period, early principal payments can begin if specific events occur. We say that during this revolving period, all the principal is reinvested unless there's a problem. You're reinvesting the principal, but somebody comes to you and says, defaults are a lot higher than what we thought. Uh-oh, we got a problem in that pool. You know what? Let's shut it down. At that point, all the principal payments can start to begin once that's triggered. That is called a rapid amortization provision. If defaults are greater than some threshold during the revolving period, principal payments begin immediately. The credit enhancements typically used for asset-backed securities backed by credit card debt, over-collateralization, and subordination. Here's an interesting one, solar ABS. In the quest to create bonds that satisfy ESG considerations, there are solar bonds, which may be considered as green bonds, backed by solar loans and leases. Solar loans on residential homes must be given junior mortgage on a property and an existing mortgage is in place. So if you have an MBS, it's backed by a pool of mortgages that have a first lien on the house. If you are buying a solar ABS, a bond for one that are backed by a pool of solar loans and leases, it may be that one of the loans you have is a second lien on a property and not a first lien. So if there is an existing mortgage in place, these loans would have to qualify as a second lien on the property. Increased level of credit risk associated with that. Also may contain a pre-funding period, which is the ability to acquire loans or leases after the closing date of the bond issuance. So let's just draw a timeline so you understand this. We'll see it more in the CLO structure. Bonds are sold, and this is the closing date as of this point in time, and you sell $100 million worth of bonds, but there's only $80 million worth of loans available by that time. So there is a period of time in which, okay, well, we'll still take the 100 million, we'll pay for these 80, but we'll add another 20 over this period of time. That is a pre-funding period. Types of credit enhancements used here: over-collateralization, subordination, and excess spread. Describe collateralized debt obligations, including their cash flows and risks. Okay, CDOs, collateralized debt obligations, are backed by a diversified pool of one or more debt obligations. If the debt backing these are corporate and emerging market bonds, it is called a collateralized bond obligation. If they are leveraged loans, it's called a collateralized loan obligation. If there are other CDOs, it is called a structured finance CDO. And if they're backed by CDSs on other CDOs, it's called a synthetic CDO. The cash flows from this come from being the seller of the CDS. This is insurance policy. Buyers will buy the CDS and pay a premium, a regular premium to the seller for credit protection. The seller sells the protection, and that's the source of the cash flows. So a CDO can have a bunch of loans backing it, right? And you have a CDO. And you can have another CDO with a bunch of loans backing it as well. And these CDOs issue bonds, right? Bonds. Well, you can take a pool of all of these bonds and create a CDO. That's what this is, sometimes called CDO squared. CLO. This is where we spend most of the time with the collateralized loan obligation. Typically tranched, the collateral pool is not fixed, which means the assets in the pool can be bought and sold. This introduces the potential for gains and losses on the disposition of assets. And since you're going to actively manage the pool, it requires a collateral manager. The goal here is simple. Generate a return on the assets that's greater than the return offered on the bonds sold. So what are you really doing here? You're going to sell $100 million in bonds, and you're going to say, you know what I can do? Let me sell $100 million of bonds, and I'm going to go buy some of this debt. And I'm going to try to get a better return on the debt than I have to pay the bondholders. You're basically just an active debt fund, aren't you? So here's the structure of what it looks like. You have a collateral manager, and the collateral manager will go looking for debt, whether it be leveraged loans, whether it be corporate bonds, emerging market bonds, whether it be bonds already issued by existing CDOs. It goes and finds a whole bunch of debt. That becomes the underlying collateral pool. Then it will sell bonds against that pool, and of course there is credit tranching involved here. There is the collateral pool. And the principal and interest and any prepayments are passed through to the bond investors. So far it sounds like an MBS, except for this part, sales. That introduces gains or losses on the underlying collateral. If you have a pool of mortgages and you issue mortgage-backed securities, everybody gets paid out as the mortgage holders pay off their bonds. That's it, unless there are defaults. If you have a CDO and you have a collateral manager, you do have active management of the collateral pool, which means the manager can opportunistically say, you know what, there's a good gain in these particular bonds. If I continue to hold them, these premium bonds that I now have will be amortized down to par over time. They will be pulled to par. I'll lose that gain. Why don't I sell them now and either return that money to the bondholders, or if it's during a revolving period, because CLOs have that as well, this revolving period in the first couple of years, I'll just buy more of other types of debt. Okay, let's look at how a CLO is constructed. And I should point out that what we're looking at here is the general form of a CLO since the Great Financial Crisis. Since 2008, 2009, rules have changed. The composition of the CLO is made up primarily of senior secured loans. Prior to that, there could have been a whole bunch of things, but it really got narrowed down to that after that event. So let's go look for some companies. And the companies we're looking for are high yield companies, and they will have capital structure made up of senior secured loans, subordinated debt, and equity. And we will look for these particular loans, and they are selected for our collateral pool. So we end up with the CLO with a diversified portfolio of senior secured loans. We'll explain what diversified means. There are limitations to industry concentration and things like that. We'll explain that on the next screen. The value of the collateral exceeds the CLO debt. So there is over-collateralization, and that over-collateralization will matter when we distinguish between a cash flow CLO and a market value CLO. Generally 100 to 225 issuers, and it is actively managed by a collateral manager. Then the SPE, which is holding the CLO collateral, issues bonds in different tranches. So you have different credit tranches and you have an equity tranche. And the equity tranche, like all other securitized structures, receives all of the residual cash flows. Everybody gets paid out first and then they get the residual cash flow. So equity-like risk and they get the residual of all of the aggregate cash flows in from the collateral, all of the money, interest and principal they pay, and then the SPE has to pay off all of the bondholders. Whatever is left over goes to the equity tranche. So it's the residual of the aggregate cash flows in minus the aggregate cash flows out. Types of CLOs, cash flow CLO is the most common. That just means that we have collateral. The collateral pays interest and principal. We take that interest and principal. We pay off all the bondholders. Whatever's left over goes to the equity tranche. That's the end of it. A market value CLO. The tranche return depends on the market value of the CLO. This is in relation to the over-collateralization test. Here's the deal. A CLO need not sell any of its loans. So sometimes some loans may have a market value lower than the amortized value. In other words, it has an unrealized loss. That doesn't matter. As long as they continue to hold that loan to maturity and there's a good belief that that loan will pay all its interest and principal, that loss does not matter. It does not matter for the measurement of the collateral. But for a market value CLO, the market value does matter for the over-collateralization test. We'll see that on the next screen. I am a little disappointed that the author of this module did not take at least 2 extra or 3 extra sentences and just explain the difference between the two. One gets the very real impression that the author does not understand the difference between these. Because if you did, since it's such a short explanation to explain it, don't you think you'd explain it, right? And then you have synthetic CLOs. The collateral pool is created with credit derivatives. Don't worry, we don't have to get into that. It's a little complicated. The performance of assets determines the ability to pay the tranches, obviously, right? The collateral manager must meet performance tests and collateral limits. If a manager fails, provision is triggered requiring the payoff of all principal to senior bond classes until the tests are met. We will see this test on the next screen. It is a test per tranche, a collateralization test tranche by tranche, until you get to a tranche where you no longer have over-collateralization. Once you get there, then it triggers all the payments to all the classes senior to that tranche until the problem is resolved. It effectively deleverages the CLO. Okay, let's look at the timeline for a CLO. And down here, we will look at the over-collateralization test, which will hopefully clear up the difference between the cash flow CLO and the market value CLO. But let's deal with the timeline, and I'll just draw a straight line here. And this line right here, this will be our CLO closing date. There we are. Before the CLO closing date, loans are being acquired. But there are no funds from the CLO to acquire it, so you're going to need somebody to acquire it. This is called the warehouse period. It's typically 6 to 12 months. A warehouse provider finances the purchase of loans to be paid off with the CLO proceeds. So this provider is saying, okay, I know what you're going to do. You're going to raise some money. Let's say you're going to raise $100 million. I'll start accumulating these loans now because you're never going to get them all on day one. I'll start accumulating them now, and when you close, you pay me for those plus whatever interest. We'll just treat it as short-term financing. And let's say there was $80 million that the warehouse provider was able to get by closing date, which means there's another $20 million. That would then fall into the ramp-up period, and let's say we put another point on the timeline. The ramp-up period after closing, excess CLO funds can be used to acquire more loans, typically 3 to 5 months. Then you have a reinvestment period. So let's put another point on our timeline way out here, and that will be the reinvestment period. The collateral manager is permitted to actively trade the underlying assets, and that can be up to 5 years. Then after that, you have a straight amortization period where all principal and interest flow through to the different tranches using a waterfall distribution approach, which you're familiar with. However, with one little twist, and called an over-collateralization test. And the easiest way to teach this one is to simply use a small example. Let's say we have a CLO with A, B, C, D. tranches, let's say 50, well, let's say 60, 60, 20, 15, and 5 for a total of 100, and the collateral has a par value of 110 million. So we're over collateralized by 10%. And the over collateralization test is as follows. If the value of the collateral falls below some trigger value, and whatever trigger value we set up, this is the formula we'd use: par amount of assets divided by the outstanding principal of the related tranche and all tranches senior to it. That sounds like a lot, but just follow me on this. Tranche A, here's the test. 110 million over 60 million is greater than 1. That means it is over collateralized. We're good. Go to the next one, add them together, you have 80. 110 million over 80 is greater than 1. We're over collateralized. That's good. And you keep doing that until you fail the over collateralization test. Now, I'm using 1. It might be 1.05. The trigger value might be 1.05, that as soon as you fall below 1.05, you have failed. Let's assume that by the time we get to C, it's below the 1.05. If that's the case, cash is diverted from subordinate tranches to senior tranches, which means you stop right here and all principal flows to these tranches to make them whole. And then whatever's left over, you pick up from here and continue on. That's a cash flow CLO. A market value CLO says, do not use the par amount, use the market value. Because the par amount is 110, but the market value can drop or it can increase and drop. CLOs are not marked to market. And so there's no reason why they need to change the par value of the assets or the underlying that they have, but the market value may change. Now, the collateral manager is under no pressure or obligation to sell any asset that has a unrealized loss in it. However, for the over-collateralization test, if you use market value instead of par value, you might have a better, idea of the amount of credit risk that you actually have, and it's safer for the senior tranches to use market value in case there is some unrealized losses in those loans, which is why on the previous screen for market value CLOs, we said the tranche returns will depend on the market value of the portfolio, because as soon as you fail the test, it may fail at B if we're using market value. If there was a drawdown in the market value of the loans, the over-collateralization test may fail at B, in which case all cash flows will then be diverted to the senior tranche until it is taken care of, and then all the subordinate tranches would then get their cash flows, so that the tranches below, wherever the cutoff is, the tranches below, their returns would depend upon what the over-collateralization test happened to be. Earlier, it was mentioned that the collateral manager has to meet certain performance tests, one of them being the over-collateralization test, which we've already introduced, which could be on a par value basis or a market value basis. And then some collateral limits. Here we'll look at some of those limits. The asset pool is typically senior secured loans, average credit rating of B. There will be an industry diversification criteria, such that a maximum of X% in any one particular industry. A maximum percent of non-senior secured loans, because it's typically senior secured loans, but it can include some non-senior secured loans, a maximum percentage of that, and limitations on the amount of CCC rated loans. The collateral manager does not set out to buy CCC loans. However, this is high yield, and credit downgrades are quite common, that a bond may have migrated down to CCC. The collateral manager may say, I feel fairly good about the recovery rate on this bond. It's got a market value of 55. I think the recovery rate is 65. I'll do better by holding it. However, it has a limitation on the amount of bonds it can hold at that category. The CLO equity investor is basically the owner of the pool of the loans, and the CLO debt investors are basically providing the financing to acquire the pool of loans. So it is really a fund structure. You're taking money from these people, you're investing it in this pool of assets, and you're hoping that the return you make on the assets is greater than the cost of the funds that you have to pay for. The rest belongs to the equity tranche.